Welcome to today's Explainer, folks. If you're steering a company right now, you already know that sweeping regulatory shifts can absolutely make or break your quarterly projections. So today, we're tearing into the Kenya Finance Bill 2026. Now, my goal here isn't to read you a dense legal textbook. Instead, we're going to cut right through the bureaucratic jargon of this new legislation and reveal the actual bottom-line impacts for your business. We're translating complex tax code directly into tangible business intelligence.
Here's our roadmap for this briefing. We'll start with the 2026 Finance Bill, look at digital taxes and merchant fees, break down the industry winners and losers, explain the multinational family budget, dive into e-returns and tax tech, and finally wrap up with 3 management action steps. Let's get right to it.
Section 1. The 2026 Finance Bill. I want you to frame this new law not just as some standard administrative hurdle, but as a brand new set of critical business variables.
Okay, let's dive into this. We're looking at our primary source right here, the Kenya Gazette Supplement for the Finance Bill 2026. This is the massive document laying out the fiscal framework heading into 2027. It's thick, it's incredibly complex, and it fundamentally rewrites how the government interacts with corporate revenues. But hey, don't worry, you don't need to read all 900-plus pages. We've already distilled the exact clauses that your C-suite needs to care about right now.
Moving right along to Section 2, digital taxes and merchant fees. If your business processes any kind of digital payments, and honestly, whose doesn't these days, your operational costs are about to experience a pretty significant shift.
The government is explicitly amending the Income Tax Act, and what they're doing is casting a much wider net over digital infrastructure and payment mechanisms. They aren't really introducing entirely new taxes. Instead, they're quietly changing the definitions of existing terms to capture revenue streams that used to just fly under the radar.
What's really fascinating here is how surgical this change actually is. The new definition of a management or professional fee now legally includes interchange fees and merchant service fees arising from card transactions. So why does this matter to you? Well, if you accept credit or debit cards, those hidden merchant fees that the banks and processors charge you are now legally categorized for taxation under this bracket. The cost of simply doing business and accepting a digital payment? Yeah, it just got a lot more complicated from a tax perspective.
And it certainly doesn't stop there. They have drastically expanded the definition of a royalty. The absolutely crucial point here is that a royalty isn't just a payment for music or a book publisher anymore. Under the 2026 bill, if your company pays for off-the-shelf software, a proprietary digital platform, or a third-party payment processing system, that payment falls under this expanded tax definition. Basically, if your business relies heavily on SaaS products or digital gateways, your tax liability in the royalties column is about to expand big time.
Let's transition to Section 3, industry winners and losers. The government is clearly using this finance bill to engineer the economy, using tax incentives to encourage specific corporate behaviors while penalizing others.
Look at these new first-year investment deduction rates. The contrasts are absolutely stark. If you're building a hospital facility or investing in hospital equipment, the government is handing you a massive 50% deduction in your very first year of use. But standard commercial buildings or industrial buildings, they're sitting at a mere 10%. The message is loud and clear. Investments in healthcare infrastructure are being heavily prioritized over general commercial real estate.
But there's a golden ticket hidden right in the text. To unlock the ultimate 100% investment deduction, companies must hit a cumulative investment threshold of 1 billion shillings outside of Nairobi City County and Mombasa County. This is a massive play to decentralize the economy. If your firm is planning a major capital expenditure, looking outside those 2 major metropolitan hubs could literally pay for itself in tax deductions, assuming you cross that billion-shilling line. Beyond real estate, the winners and losers are very clearly defined by industry. The massive winners? Green energy, for sure. The bill provides distinct value-added tax exemptions for electric bicycles, EV buses, and solar or lithium-ion batteries. If you're in the green supply chain, your products just got cheaper for the consumer. On the flip side, the targeted sectors face strict new percentage levies. The sale of scrap metal is now hit with a 1.5% tax on the gross amount, and the gambling industry faces a massive 20% tax on winnings. Now, for those of you operating across borders, let's look at Section 4, the multinational family budget. We're going to decode the new reporting rules for multinational enterprise groups, or MNEs. The legal text outlining these new reporting mandates is incredibly dense. Multinationals must now file highly detailed documentation within 6 months of their financial year end.
And you know, this brilliantly illustrates how we can take intimidating legal reporting requirements and translate them into something simple to understand. Just think of it like a family budget.
Imagine your multinational corporation is a large family. The master file, required by the tax authorities, is the overall family budget. It tracks the macro picture, total household revenue, the big picture growth engines, overarching research and development policies, and global supply chains. It basically proves the whole family's financial health to the taxman. Then you have the local file. Think of this as the individual allowance for the Kenyan child of the corporation. This file zeroes in specifically on what the local Kenyan entity is doing. It details the local management structure, local business strategies, and exactly how they're spending their specific allowance through local and international transactions. Both of these files are strictly required, and failing to harmonize your family budget with your individual allowance is going to trigger immediate audits.
All right, let's move to Section 5, E-Returns and Tax Tech. Because the days of filing static paper returns are officially over. Compliance is going fully digital.
The law now officially empowers the Commissioner to use information technology systems to generate pre-populated tax returns on behalf of taxpayers. This means the Kenya Revenue Authority isn't waiting around for you to tell them what you owe anymore. They are integrating their tech directly with your transactions to tell you what you owe before you even file.
Let's see how this translates into real-world enforcement. The law explicitly states that failure to comply with the electronic tax system, say failing to issue an electronic tax invoice or failing to submit returns electronically, triggers an immediate, legally mandated written notice. The Commissioner will demand you provide specific reasons for non-compliance. Ignoring the digital system integration is just no longer an option. Automated enforcement is now hard-coded right into the law.
Well, we've covered a lot of ground today, which brings us to our final section, Section 6, 3 Management Action Steps. This is the real climax of our explainer. What exactly should your C-suite do with this intelligence right now?
Here are your 3 immediate management action steps. First, you absolutely must urgently audit your digital payment and merchant fees. With the redefinition of royalties and management fees we talked about, you likely have brand new hidden AX liabilities sitting in your software and payment gateways. Second, if you're a multinational, you need to structure your master and local files immediately. Do not wait for the 6-month deadline to scramble for this data. Third, you must upgrade your financial software. Your systems have to be capable of integrating with KRA's pre-populated e-return tech to avoid those automated enforcement notices. Taking these actions right now is going to prevent some very painful financial penalties later.
I'll leave you with this final thought. Is your organization's tax infrastructure truly ready for January 2027? The rules of the game have officially changed. Thank you so much for engaging with this explainer. I strongly encourage you to take this briefing right back to your financial officers and begin those internal audits today. The clock is officially ticking.